Okay, class. So let's proceed to problem number 2. Okay, so in problem number 2, there are only minor computations. Okay, so we'll just have to reiterate some concepts regarding absorption and variable costing again. Okay, so product cost and period cost. So this is based from a reviewer book authored by Mr. Roque. So during January of the current year, a Linab company produced and sold 1,000 units of product A with costs as follows. Okay, so you have material, labor, variable, and fixed factory overhead. Okay, selling and administrative cost incurred during the month were, okay, so again, we have variable and fixed period cost. Determine the following amounts. Number 4, product cost per unit under absorption costing. Okay, so we are talking about here product cost. Okay, so product cost. Okay, so remember we have 4 components under absorption costing. So what are they? Okay, so these 4. So we have 6,000, 3,000, 2,500, and 1,500. Okay, but per unit ang tinatanong. Okay, so we have 6 plus 3 plus 2.5 plus 1.5. Okay, so we have this total. Okay, 13,000. So basically, 13,000 divided by 1,000. Okay, so we have 13 per unit. Okay, so this is your answer. 13. Okay, for question number 5, product cost again pero under variable costing. Okay, so under variable costing, there are only 3 components of product cost. Okay, so we have materials, labor, and variable overhead. So these 3 only. Okay, so 6,000 plus 3,000 plus 2,500. Okay, sige. 6,000 plus 3,000 plus 2,500. Okay, so we have 11,500. So 11,500 divided by 1,000 again. Okay, so we have 11.5, definitely. Okay, so the answer would be letter B. Okay, so 11.5. Okay, next, number 6. What is the cost of goods sold per unit? Okay, so the cost of goods sold, okay, it would be the same as your product cost under absorption costing. Okay, so 4 components again. 4 components. Okay, so all 4, 13,000. Again, the answer is letter A, 13. Okay, next, number 7. Variable cost per unit, which will be deducted from sales price in arriving at unit contribution margin or contribution margin. Okay, so in variable costing, we have sales less variable cost equals contribution margin. Okay, so what is the variable cost per unit? So variable cost per unit includes manufacturing and selling and admin expense. Okay, so reiteration only. So for manufacturing, we have 3. The product cost. So this is the product cost under variable costing. Okay, so we have 11,500. On a per unit basis, divide this by 1,000. So you will have 11.5. For selling and admin expense, we have variable selling and admin expense. So this is amounted to 3,000 pesos. Okay, so 3,000 per unit ang tinatanong. So divided by 1,000. Okay, so we have 3. So the answer would be 14.5. Okay, so letter D. Okay, so as you can see, it's not the same as this one. So cost of goods sold per unit and product cost under absorption costing will be the same. But the variable cost per unit and the product cost under variable costing will not be equal. Okay, so in number 7, we still need the selling and admin expense, variable selling and admin expense. Okay, so that's it for question number 2. Okay, reiteration only of some concepts. Next, problem number 3. Okay, so problem number 3, we're going to talk about the variable costing ending inventory, as well as, of course, absorption costing ending inventory. So the following information pertains to Angeles Corporation. So here we have beginning 2,000 and ending inventory 5,000. Direct labor per unit is 10, materials 8, variable overhead 2, fixed overhead 5, selling variable 6, fixed selling 8. What is the value of ending inventory using the absorption costing method? Okay, so the ending inventory in units totaled 5,000. But we need the balance or the value. Okay, so how do we compute for the value of this ending inventory under absorption costing method? Okay, so we have to apply the concept of the components of product cost. So under absorption costing method, there are 4 components. Okay, so these 4. Okay, so 10 plus 8 plus 2 plus 5, that is 25 per unit. Okay, so this is 25 per unit. You just have to multiply this by the number of units and the ending inventory. So that is 5,000. Okay, so every unit, okay, the value is 25. Then it is for the total, we have to multiply. So 25 times 5,000. Okay, so that is 125,000 ata. Okay, so okay, correct. 125,000. Okay, so this is 125,000. So the answer is letter C. Next, what is the value of ending inventory using the variable costing method? Okay, so under variable costing method, there are only 3 components. Okay, so 3 components, fixed overhead is not included. So only these 3. Okay, so only these these 3. Yeah, 10 plus 8 plus 2, that is 20. So same times 5,000 because question asks for the ending inventory. So 20 times 5,000, so mentally 100,000. So the answer is letter B. Okay, so this is just a reiteration of the concepts that we have discussed in part 1. Okay, so when we are asked about the value of the inventory, okay, so value of inventory, it will be always higher than absorption costing. Okay, so I mean, it will be always higher under absorption costing than in variable costing. Why? Because under absorption costing, there are 4 components, including the fixed overhead. But under the variable costing, there are only 3 components. Okay, so excluding fixed overhead. Okay, so value of inventory always higher under absorption costing method. Okay, but okay, in reference to what we have learned in previous problem, but when we are asked about the profit, okay, so it depends. Sometimes net income under absorption is higher. Net income under invariable may also be higher in some cases. Okay, so it depends. It depends on what? It depends on the difference, okay, between the production and sales. Okay, so when we are asked about the profit, but when we are asked about the value of merchandise inventory, always higher under absorption costing. But when it comes to profit, it depends on the units produced and units sold. Okay, in number 10, question is, what is the difference in amount of operating profit between absorption costing and variable costing? So we are not after the computation of net income under these 2 costing methods, but the difference only. Okay, the difference is, that is your reconciling item. Okay, so I have already taught you the difference between the variable costing income and the absorption costing income. Okay, so we have this one. The reconciling item pertains to what? Okay, so the product, no, of the change in inventory times the fixed overhead rate. Okay, so this is what we have done in problem 1. Okay, so change in inventory times fixed overhead rate. So that's the difference. Okay, so change in inventory. So how do we compute for change in inventory? So that's the difference between these two, okay, between the production and sales. However, when we check problem number 3, there are no information about the production and sales in units. Okay, I have also discussed with you the alternative. Okay, so what's the alternative for the change in inventory? Of course, we refer to the inventory themselves. Okay, so how much or how does it change? No, our inventory from 2,000 units to 5,000 units. So definitely there is an increase of 3,000. So how do you compute for that? So ending inventory less beginning inventory. Okay, so multiply by FOH. So this is an alternative way to compute for the difference. Okay, if production and sales are not provided. So ending inventory is 5K less 3K. Okay, multiply by FOH rate amounting to, okay, so we have 5. So times 5. So definitely this is 2,000 times 5. So this is 10,000. Okay, so the answer is letter B. Okay, so that's it for problem. Okay, so let's proceed to problem 4. Okay, problem 4, we're going to include in our discussion the effect of volume variance. Okay, so volume variance, you have probably learned this in your cost accounting course, specifically under standard costing and variance analysis. We're not going to talk about all variances here, but only volume variance. Okay, so let's read the problem. The following information pertains to ACES Corporation. So you are given with sales price, variable production cost. So variable production cost is composed of the 3 components. So we have direct materials, direct labor, and variable overhead. Okay, so it is given in lump sum here. Fixed production overhead 20, and then variable expense per unit 10, fixed expense total 100,000. Okay, we have here beginning inventory of 4,000 units, then normal capacity of 20,000 units. Okay, our fixed production overhead per unit is based on the normal capacity. Under each scenario, compute for the profit under both full costing and direct costing respectively. Okay, so that's our question. Okay, so here we have sales total 22,000 units, but the production is 21,000 units only. So your production is less than your sales. Okay, so we know that the absorption costing income should be less than, okay, your variable costing income. Okay, anyway, so how do we incorporate the volume variance? So let's talk about the volume variance. Okay, so volume variance, since our fixed production overhead is based on normal capacity, so our budgeted fixed production overhead, when we compute for this, 20,000 times 20, this is how much? 400,000. Okay, so 20,000 times 20. Okay, so we have 400,000. So this 400,000 is actually your budgeted production overhead, fixed production overhead. Okay, but when we produce, okay, we're going to apply this 20 pesos fixed production overhead rate to the entire 21,000, to the actual production. And that's why there would be a volume variance. So the volume variance pertains to the difference between the normal capacity and your actual production, okay, in units. Okay, remember, when we compute for the fixed overhead rate, or when we compute for the fixed overhead under absorption costing, fixed overhead cost component of the cost of goods sold, we multiply the rate by the number of units produced. Okay, sir, now there are two figures related to production. So we have the normal capacity of 21,000 and the actual production capacity of 21,000. Okay, so what are we going to use in computation or in computing for the total fixed overhead rate, or fixed overhead, sorry. Okay, so let's compute first the volume variance. Then let's illustrate the effect of this volume variance on the computation of operating income. Okay, so the volume variance, the formula to compute for the volume variance would be as follows. Okay, so normal capacity, okay, less actual production. Okay, so we have 20,000 and then 21,000 is our actual, so there is a difference of 1,000 negative. Okay, then multiply this by FOH rate. Okay, so our FOH rate is 20. Okay, so 20. So negative 20,000. This is your volume variance, and your volume variance is unfavorable volume variance. Favorable volume variance. So why is it favorable? Because it is negative. Okay. Kidding aside, this is favorable because our normal capacity, when we say normal capacity, it is based on 3 to 5 years, no, of information. So normally we produce only up to 20,000. Okay, our warehouse, for example, the capacity of our warehouse normally is 20,000. But during the current year, we were able to produce 21,000. So we have exceeded our capacity. Isn't it favorable? We were actually able to produce greater number of units than what we normally produce in 3 to 5 years of time. Okay, so that makes it favorable. Okay, so yeah. Okay, so we have already computed for the volume variance. So that's simply normal capacity less actual capacity or actual production. Then multiply this. The difference should be multiplied by the fixed overhead rate, which is 20 in this problem. So we have 20,000. So if it's negative, again, it's favorable. Why? Because we have exceeded our capacity, okay, to produce. Okay, so now let's compute the operating profit under the two costing methods. Okay, so let's begin with absorption costing. Okay, so sales. So our sales amounted to selling price is 200. Okay, so 200 times 22,000 units sold. Okay, so 200 times 22,000. Okay, so we have 4.4 million. Okay, next, cost of goods sold. Okay, so for cost of goods sold, okay, definitely this includes variable production cost and fixed production overhead. So 120 plus 20, that is 140. Multiply by 22,000. Okay, so 140 times 22,000. Okay, so that will give you 3,080,000. Okay, next. So how do we incorporate the volume variance? Okay, volume variance is normally what? Is close to what account? So it depends whether significant or insignificant. Okay, anyway, so let's just assume that this is insignificant, and therefore the entire amount will be adjusted to or close to cost of goods sold. Okay, so just like what you have learned in cost accounting. Okay, so volume variance 20,000 negative, so you just have to copy the sign. So if it's negative, then it's a deduction to your cost of goods sold. But if it's if it is being adjusted to your net income, of course, favorable, therefore it would be added. Okay, so deduction to your cost of goods sold, favorable. Okay, but when it comes to net income, it's an addition. That's why favorable. Anyway, so this would be 3,060,000. Okay, so let's compute for the gross profit. So your gross profit amounted to 1,320. Next, selling admin expense. So we have variable and fixed. Okay, so how much is your variable? Okay, so our variable expense per unit is 10. Okay, and then fixed expense is 100,000. So 10 times 22,000. So this is 220, while your fixed selling expense amounted to 100,000. Okay, so this is your net income under absorption costing. Okay, just make sure that your volume variance is incorporated in your income statement. So it can be an adjustment to your cost of goods sold or an adjustment to your net income itself. Okay, so 1,320 less 320,000. Okay, so this is 1 million. Okay, so 1 million. Okay, so do we have 1 million as an answer? Yes. Okay, wait. 3,060,000. Okay. Upon checking, 4.4 million less 3,060,000. Okay, it should be 1,340. So where did I get this one? Okay, let's just change this. Sorry. So 1,320. It should be 1,340. Okay, so 1,340 less 220 less 100,000. So this is 1,020,000. It should be 1,020,000. Okay. Sorry for that. So 1,020,000. Okay, next we compute for the variable costing income. Okay. Variable costing income is not affected by volume variance. Only absorption costing income will be affected by volume variance. So you would not see any volume variance item in variable costing income. So your formula will still be the same. So for sales, it will still be 4.4 million. Okay? Then you have variable cost. This is your manufacturing and selling and admin. Okay, so how much? Okay, so let's see. Okay, so for production and 120, and then variable 10. So that's a total of 130. Okay, so this is 120, and then this is 10. So a total of 130. So 130 multiplied by number of units sold. So 130 times 22, 2,860. So this is 2,860. Okay, so this is your contribution margin. Okay, so 4 less, okay, 4.8. 4.4. So kung ba yan? 4.4. So 1,540. This is your contribution margin less fixed cost. Okay, manufacturing and selling and admin also. For selling and admin, so 100,000, it is given. But for manufacturing, so how do you compute? Okay, we have fixed overhead rate only. So we have to compute for the total. So fixed overhead rate 20. So 20. So how do you compute for this one? So 20 times number of units produced. Tama? Okay, so 20 times number of units produced. However, there are two figures related to production. Okay, so we have 20,000 and 21,000. So normal and then actual. Okay, so where are we going to base this fixed manufacturing overhead cost? Okay, we have to base it on the normal capacity. So in case there is a conflict between the actual and the normal production, we have to base it on the normal capacity, because according to this problem, the fixed overhead rate is based on the normal capacity. So we have to make use of this. Okay, so that is simply 20 times 20,000. Okay, so that is around 400. Okay, so no need to use the calculator. So 400,000. Okay, so again, your net income under variable costing amounted to 1,540 less 500,000. Okay, so we have 1,040,000. Okay, so 1,040,000. So 1,020,000 under absorption, and then variable 1,040,000. Okay, we can check. We can confirm. Okay, so under variable costing, under absorption costing. So we just have to reconcile. Okay, so this is 1,040,000. This is 1,020,000. So let's see if our answers are correct. Okay, so what's the reconciling item again? Okay, so this one, what is the reconciling item? Change in inventory. Okay, change in inventory times FOH rate. So same. Okay, so change in inventory, production minus sales. Okay, actual production minus sales. So our production is 21. Okay, so let's erase this. So our production is 21,000, and then our sales is 22. So how much is how many units? Okay, they differ. So we have 1,000. Okay, so this is the difference between the two. Okay, so difference is 1,000 units multiplied by what? So negative, okay, by the fixed overhead rate, which is 20. Okay, so again, 21 less 22, so that is negative 1,000 times 20. That will give you negative 20,000 as your reconciling item. So 1,040,000 minus 20,000, so you will have 1,020,000. So again, our answer is correct. Okay, so that's for problem number 4, question number 11. Okay, there is a follow-up question for problem number 4. Okay, so the following information, same given. I just copy this problem, no, for this question number 12. But this time, production is greater than sales, and also your normal capacity is greater than your actual production. So let's compute first the volume variance. So volume variance, so again, normal capacity, okay, less actual production. So 20,000 less 18,000. So we have 2,000 multiplied by fixed overhead rate, which is 20. Okay, so positive. Okay, so we have 40,000. Okay, 40,000. So this is unfavorable. Why? Because it's positive. Okay, aside from that, our capacity to produce is 20,000, but we have produced only 18,000 during the current period. So we have not maximized our normal capacity, and therefore it is unfavorable on the part of our cost. Okay, so let's compute for the production operating profit rather. However, for this one, let's just compute the variable costing. Okay, variable costing income, and then we just reconcile. Okay, so variable costing, under variable costing, but you can solve, okay, on your own, the net income under absorption costing. So I'll just do the variable costing income. So sales, we have 15,000 times 200. Okay, times 200. 15,000 times 200. Okay, so we have 3 million. So 3 million, then less variable cost, manufacturing and selling admin expense. Okay, so for manufacturing, okay, we have 120, and then for variable cost per unit 10. So we have a total of 130 again. So 15,000 times 130. Okay, so that will give you 400, no, 15,000, sorry, 15,000 times 130. Okay, so that will give you 1950. This is your total variable cost. Okay, so you will have your CM, contribution margin. So less 3 million. Okay, so we have 1,050,000. Next, we have fixed cost. So manufacturing and selling and admin again. Okay, so for manufacturing, okay, so we are going to use the what? Okay, normal capacity again. So 20,000 times 2. So this is still 400,000. And our selling and admin expense fixed 100,000 given. Okay, so same as the last one. So this is 550. Okay, you can do it mentally. So 550. This is your variable costing income. Okay, then we'll just reconcile. Okay, so this is your plus or minus adjustment. And then absorption costing income. Okay. Okay, so we determine production less sales. Okay. So our production is 18,000. So less 13,000. So this is the change in inventory, 5,000. Sorry, it should be 15,000. I'm sorry. Okay, so again, let's see. Okay. So 18 and 15. So 18 and 15,000. So we have 3,000 as our change in inventory. Multiply by fixed overhead rate, which is 20. Okay, so the difference is 60,000. Okay, so 60 positive. Okay, positive. So plus 60 plus 550, this is 610,000. So when you solve it on your own, the absorption costing income should be 610. Okay, so let's see. Okay, for question number 12, so the answer would be letter B. 550, I'm sorry. Full costing, that's absorption. Direct costing, that is your variable. So baligtad, it should be 610 and 550. Okay. For question number 11, so we have not answered this one. So 1,020,000 for absorption. For variable, 1,040,000. Okay. So the answer is letter C. Okay, so that's it for problem number 4. Next is throughput costing. So let's wait for my next video regarding this throughput costing. Okay, thank you.